So today I'm going to start talking about. So today I'm going to start talking about developing a model for predicting stock price, and we're going to touch on a couple subjects that I think you'll pretty much understand already, but I wanted to highlight it. So many of you have had me in IME 239 when we learned about assets and liabilities and accounting, and so in general, the idea is that assets of a firm are made up of factories, the inventory, the money, desks, patents, anything that makes up the value of the firm. That is actually equal to the ownership of the firm. So people who own the firm can either be liabilities, which are generally banks or bondholders, or equity holders, which are owners generally thought of as the owners of the firm. In a corporation, they are the stockholders of the firm. So when we keep this in mind, that this equation has to balance, it's the basic um, accounting equation. Now we're going to go through and look at, well, how does this relate to cash flow and to the value of the firm, the value of the stock price. So what we want to do is we want to look at the assets, and every year the assets generate an amount of cash flow, and that cash flow is the revenue minus the expenses, which is the profit, and then you also take out taxes. So that will be the cash flow from the assets. That's what comes off the assets every year. So what we're looking at is sort of two dimensions. One is the value of it, and then the other is the ongoing cash flow from this. Theoretically, these assets can generate cash flow forever. As long as they're okay assets and they continue, they don't wear out, you can do this forever. So it's kind of like a two dimensions looking at it. Now, if we look at the other side and look at what are the cash flow equivalents for both liabilities and equity, liabilities are actually easy. It's equal to the interest per year. So when you have a firm and you've borrowed money to finance it, in order to pay it back, you have to pay an interest every year. So that's what the equivalent, the value of the loan is the initial value, and then the interest per year is what you pay to keep that loan. So just by difference, that cash flow from the equity is going to be the cash flow from the up here from the assets minus the interest. So it's just like assets minus liabilities would equal equity. The cash flow from assets minus the cash from liability is equal to the cash to the equity holders. So every year the equity holders get some money. Now they have choices about what to do with this, and the board of directors decides what to do. They can either pay it out in dividends, or they can generally reinvest it into the assets to provide growth for the firm. And that's the idea, that if you can take it out, then you'll just get immediate benefits. But if you put it back into the firm, you will get ongoing growth. So let's look at a numbers example. I'm much more practical, and usually when I'm looking at stuff, I like to look at the actual numbers associated with it. So if we look at the assets of a firm, let's just say there's $2,000 of assets. This could be $2 million or whatever, but there's a quantity of $2,000. Now, if these assets are fairly risky, they would require a 10% return every year. And that's like any investment you make. Just imagine that all of your assets are in a bank. You would expect some sort of interest rate per year. Instead, you've invested it in this corporation, so you also expect some kind of interest rate per year or some kind of return every year. So if we just do that calculation, if we do 10% of 2,000, we would expect $200 a year to be generated by these assets. Now that is equal to some revenue value minus an expense minus taxes. That value is $200. Now if we look at the other side, let's just say we have liabilities of $500. So in order to finance this firm, we got a $500 loan. Now the interest rate on that 500 is somewhat lower because it's lower risk than the assets in general, but it's a good rate right now for long-term corporate bonds is about 5%. Now that means that generally you'll be paying $25 per year for this loan. $500 times 0.05 is $25 a year. Now, by difference, we can do some calculations about equity. So the equity value we know is there's $2,000 of assets, plus we have $500 that belongs to the bank. So that means the equity holders have $1,500. And if we look at the cash side, we have $200 a year, minus the interest rate of $25, that means the equity holders are getting $175 a year. This is just purely by difference. So what does that mean in a rate of return? So if we look at this rate of return, we have $175 cash flow divided by the value of that, $1,500. So the equity holders in this firm are getting 11.6%. Now, there's a couple things to notice about this. First of all, we look at this, the assets are 10%, which are fairly risky. That's why it's a 10% return. The lower required return means that it's less risky. So liabilities are less risky. This higher return means the equity holders are taking on more of a risk of this firm. Now we'll talk about risk and return a little bit later, but I just wanted to have you notice that. So if I look at kind of a summary table, remember we had $2,000, liabilities $500, and that means equity is $1,500. The cash from the assets was $200, minus the interest rate left $175. And if we just purely divide this all out, we get 11.6%. We can fill in all of this. Now, what that means is really the summary here is that the cash flow for in any year A from an asset P at an interest rate I is equal to A times P times I. Now, I don't know if you remember this equation from engineering economy. Maybe you can look it up and see when is this equation used in engineering economy. And then the basic assets is equal liabilities plus equity. So what's going to happen is for your homework, you're going to enter when is this particular equation used in engineering economy. I want you to look that up if you can remember.